What are the best stop loss strategies and how should you be placing your stop loss? So hello, welcome back, welcome to a new video, and I got asked quite a bit about stop loss orders and how to place a stop loss. And in this video I will answer this, and at the end of this video we will go through a few charts together and I will be showing you how to place a stop loss the right way. But first of all, let me just share a few principles, tips and tricks from the greatest traders that have ever lived, probably. So we're starting with Bruce Kovner. And if you don't know him, you probably should. He is one of the best and biggest hedge fund managers out there, and his net worth is a few $1 billion. So we should really listen to what he had to say, and he had been interviewed in multiple different books, and there are a few things that he is sharing. So the first one is, whenever I enter a position, I have a predetermined stop. I know where I'm getting out before I get in. That's very, very important, because obviously there is this other quote: the last moment of objectivity is before you place a trade. Once you're in the trade, then money is on the line. You are very, very emotional very often with the money that is being risked, and then you cannot make objective decisions anymore. So before you get into a trade, be very clear of where your stop loss is going to be. Second, the position size on a trade is determined by the stop, and the stop is determined on a technical basis. Very, very important. Technical basis is the key here, and it's the same for the 0.3. I always place my stop beyond some technical barrier. So the keyword is here really beyond and technical barrier. And once we get into the chart soon, I will show you how to do that. And the last point, I place my stop at a point that is too far away or too difficult to reach easily. That is very important as well. Then another one from Bruce is, he said, place your stops at a point that, if reached, will reasonably indicate that the trade is wrong. That is very important, because every trade has a hypothesis. You trade a breakout, then understand and ask yourself, what is the trade saying? What is the expression of the trade? The breakout should usually mean that the momentum is gathering, the price is taking off, a new trending leg is being started. So you want to put your stop loss at a place where, if the breakout doesn't succeed, then the trade idea is being invalidated. It's not verified anymore. And he also said, not at a point determined primarily by the maximum dollar amount you're willing to lose. This is exactly what most amateur traders do, is they don't put their stop loss where it would make sense based on the trade idea, but they're putting their stop loss at a place where based on how much money they are willing to lose. And obviously those places, they have no chart context. They have nothing to do with the overall trade and the overall trading scenario. And Alexander Ender, two more quotes from him. As soon as you buy, place a stop loss order. Very, very important. You should never be in a trade without a stop loss. We all like to hope that a trade will succeed, and a stop is a piece of reality that prevents traders from hanging on to empty hope. So important. The stop loss is the point where your trade idea is proven wrong, where you should not be in the market anymore. And if you let the price run through the stop loss and you're not executing the trade and the stop loss, then you have made one of the biggest mistakes that a trader can ever make. So when it comes to stops, there are three different approaches. This is what amateurs usually use. It's a fixed point or a fixed pip or a fixed dollar stop loss. It is rigid, it's not flexible, and it will quickly stop working. This is the worst thing that you can do for a stop loss. So many traders say, I always use a 50 pip stop, I always use a 20-point stop, I use a $50 stop. This has nothing to do with the chart context. It is usually placed at completely random price levels where it has nothing to do with the price action. This is what Bruce Kovner also recommends, and this is what I'm going to show you: natural price action stop loss. They are flexible, they are adaptive, because you always place them based on chart context, and you can deal with volatility. When the market changes, and this is a guarantee, it's a certainty, the market will change over time, then a stop loss that is placed on natural price action will always be changing with it. And the third thing is that many amateur traders do, they don't trade with a stop. If you're not having a stop with your trades, you have no business of being a trader. A trade without a stop loss is one of the biggest mistakes. It's a great trading sin. If you're taking a trade and you don't have a stop loss, you should not be a trader. That's very simple. No trade without a stop loss. So let's take a look at a few charts, and I will show you exactly how to place stops. Those are usually trades that I've taken, or some have taken also my students. And those are the stop techniques that I teach also in our masterclass and in the courses. It is always a natural price action based stop loss approach, because that's the stop loss that will always work. It has always worked. It always stays adaptive to the market and to the chart context. So let's assume we are breakout traders and we are looking here for a market reversal. The market has been in a strong uptrend. Then you identify this range market. We can draw a very well-defined trend line here, which captures the lows, and we're waiting for a breakout. The breakout happens here at this point. So let's take a look with the replay tool in TradingView how the market looked back then on the breakout. And then let's think about how we're going to place the stop loss. So to place a natural price action stop loss, you look for barriers. You want to protect your stop loss behind some natural price barrier. And you could use obviously trend lines. You can also use horizontal levels, obviously. You can use moving averages, and you could also use pivot points. There are many other things that you could use, but yeah, those are the most commonly used ones. So in this example, we have a trend line here. So we have one price action barrier. We could also try to use the 20 MA, and you can see in this case the moving average is here. So and then it depends a little bit on your risk profile. How aggressive do you want to be? The most important point is that you never place the stop loss right at the price barrier. As Bruce Kovner said in the first part, is you always place the stop loss beyond the price action barrier, because obviously many traders will be aware of those lines and those levels. So you will often see retests and pullbacks into those areas. And sometimes the volatility can really pick up around those levels. So you want to put the stop loss beyond this to get some kind of protection. And then it really depends on yourself. How conservative do you want to be? Where is it? So here you can say, okay, do you want to be very aggressive? Then let me zoom in a bit. Then you just put your price alert, your stop loss just a little bit above this trend line. However, the closer it is, the more likely it is that you will be taken out, obviously. You could also use the moving average as a second barrier. The moving average is here. And you could have a rule for that. Some traders do that. They have a rule of having two price action barriers between the stop loss and between the price and the stop loss. That could be also a rule. So think about it. What type of stop loss approach do you want to apply to your trading? We have a trend line here, and we also have here a moving average. And this is how you place the stop loss. We can fast forward here a little bit, and you can see that right after the entry, the volatility did pick up quite a bit. You can see that this candle here overshot the trend line significantly, but came short of this moving average. So in this case, a very tight stop loss approach would have not worked out. And the tighter the stop loss approach, the more often you will be taken out. Obviously also your reward to risk ratio usually will be a little bit higher. And then you can see the price still hovers around this trend line quite a bit. And this is something that you will see very often. The price really is often pulled into those levels because many people will place their stop loss right at the level, and then they will get taken out. And then you can see eventually after the market has taken out everyone who placed their stop loss too close to the market and to the trend line are taken out. The market then really takes off, and then at one point the new downtrend is really accelerating. So this is pretty much how you can place a stop loss based on price action flow. We can take a look at another example, very similar approach. The market was in a downtrend. Then here at the bottom you can see the market is fading out. It's putting in a divergence here first, another divergence, and then a double bottom. Then the market breaks out here above the trend line, a very well-defined trend line as well. And this is the breakout point. So let's again use the replay to look at how the market looked like on the breakout. And this is the price action situation on the breakout above the trend line. And then you have a choice of using just the trend line or the moving average. Some traders will also want to use pivot points, and especially the central pivot point can be a great filter for that as well. So here you can see in red, this is the central pivot point of that day. We have the moving average in here and we have the trend line in here. So we could even have 3 protection levels here that could help us place our stop loss somewhere. So in this case, to be really safe, you could use here's the moving average. You don't want to put the stop loss right at the moving average. You want to put it beyond it, as Bruce Kovner also said. And then your take profit can be somewhere based on your take profit rules. So your stop loss is really, really protected now. The market would have to make a very deep pullback to reach the stop loss. And some traders even go one step further, who they place the stop loss beyond the low. Because in this case, if the market really pulls back that deep, you don't want to be in the trade anymore at all, because your trade idea is to have a breakout, and your trade idea is that the market will start a bullish phase now. And if the market reaches this point here, you don't want to be in the trade anymore, because if the market really gets there, obviously your trade idea is proven wrong. However, you may say, okay, if the market makes it still maybe until this point, it stays above the previous low point, I still want to be in the trade because the market may still turn around and my trade idea hasn't been proven wrong completely. So this could also be an option. Depends a little bit on your aggressiveness. And then you can see the market does make a little bit of a retracement, does pull back a little bit. It doesn't immediately take off, and you can see then afterwards it is taking off. It comes back to your entry point. It challenges everybody who has placed their stop loss a little bit too close and too tight. And then you can see the market eventually moves higher and higher. And then you could use stop loss trading approaches, for example, trading the stop loss beyond the moving average or beyond the daily pivot point or below support and resistance levels. That's a little bit up to you. And that is essentially how you would place a stop loss. Again, let me summarize it. Look for protection barriers. Look for more than one protection barrier if that's something that you want to apply. Moving averages, trend lines, support and resistance, pivot points, or even maybe highs and lows. Don't put it at the level, but put it beyond the level, just to have more extra insurance and to protect your stop loss even further. And don't move your stop loss to break even too soon. That's another amateur mistake. Give your stop loss time and give the trade time to unfold, because very often you will see pullbacks into the entry, you will see pullbacks into the support and resistance tools that you're using, because many traders will use them, and pullbacks are very, very common. So this is how you can use stops in a much, much better and more effective way.